Philips just dropped their Q2 2026 earnings, and they officially beat consensus across the board. We're jumping straight into these numbers because, well, top line, group sales came in at 4.36 billion euros, which represents a solid 4% comparable sales growth.
Right.
And bottom line, basic earnings per share landed at 40 euro cents. Now, looking ahead at the guidance, they reiterated their full-year comparable sales growth expectation of 3% to 4.5%.
Which is pretty standard, yeah.
But here is where it gets really interesting, and frankly, why the stock is popping today. They actually raised their adjusted EBITDA margin guidance to a range of 13.5% to 14.0%.
Up from the previous 12.5% to 13.0%. Yeah.
Exactly, and they bumped up their free cash flow guidance to 1.5 to 1.7 billion euros, which is up from a ceiling of 1.5 billion previously.
So for a retail investor looking at this print, those headline numbers paint a very almost aggressive picture of growth. When you see solid top-line revenue coupled with raised guidance on both margin and cash flow, I mean, traditional financial modeling suggests really strong operational leverage. The initial takeaway is that the company isn't just selling more equipment, they're becoming significantly more efficient at, squeezing profit out of every single euro they brew in.
Okay, but I want to push back on that initial takeaway right away. Because as an investor, my instinct when seeing raised margin and cash flow guidance is to assume they are absolutely crushing it on the factory floor, or their sales reps are closing massive deals.
Sure, that's a natural assumption.
But when you actually read the fine print in this report, Philips explicitly states that this bump is almost entirely due to a U.S. tariff refund.
Yeah, that is a massive caveat.
We are talking about a huge one-time cash injection. So the core question for this deep dive is, does this quarter actually show fundamental business strength? Or is that refund just masking, underlying cost inflation that's quietly eating away at their core business?
That is the multi-billion euro question, honestly. And to find the answer, we have to look past those consolidated group numbers.
Right, look under the hood.
Exactly. If we just look at the blended 4% growth, we totally miss the reality that their operational strength is, well, it's highly fragmented right now.
How so?
There are areas of genuine, impressive momentum, but there are also divisions where that U.S. tariff refund is doing an awful lot of heavy lifting to cover up some structural weaknesses.
So let's break those individual segments down to see where the real growth is hiding. The standout star this quarter, undeniably, is their personal health division.
Oh, absolutely.
They pulled in 909 million euros in sales, delivering an 8% comparable sales growth and a massive 23.0% adjusted EBITDA margin.
The driver behind that personal health growth is super interesting to look at. While the momentum is broad-based globally, a massive catalyst was the launch of this the S800 series compact shaver in China.
Yeah, I saw that in the notes. The shaver with was it the TurboMax motor doing 5 million cuts per minute?
That's the one.
I have to admit, that sounds like pure marketing fluff to me. I mean, how does a single consumer grooming product move the needle so significantly for a sprawling global medical technology company?
It sounds like a minor detail, I know, but you have to look at the actual mechanics of consumer hardware margins.
Okay.
Personal health products, like high-end electric shavers, have significantly lower research development and regulatory costs compared to, say, launching a new MRI machine.
Oh, sure. You don't need FDA approval for a shaver.
Exactly. The time to market is so much faster. So when you launch a premium product in a massive consumer market like China and it hits, that margin flow-through is immediate and it's substantial.
That makes total sense.
It proves Philips still has the engineering and marketing agility to capture market share in a really competitive environment. They aren't just, coasting on legacy brand recognition. They're actively driving top-line growth through fast-cycle hardware innovation.
Okay, so that covers the consumer side, but then we pivot to the other two segments, diagnosis and treatment and connected care.
The heavy hitters.
Right. This is the enterprise-level medical tech that hospitals actually rely on. And both of these divisions only delivered 2% comparable sales growth.
A definite slowdown compared to personal health.
Yeah. And the detail that really caught my eye, the one that makes me question the entire fundamental growth story here, is the order intake. Comparable order intake for the entire group actually declined by 1%.
You are absolutely right to highlight that. For a company selling, multi-million euro imaging machines and hospital-wide monitoring networks, quarterly revenue is a lagging indicator.
It tells you what they sold a year ago.
Exactly. Order intake is your leading indicator. It tells you what revenue is going to look like tomorrow. So a 1% decline there is exactly what spooks institutional investors, because it suggests the sales pipeline might be drying up.
No, management commentary blames this 1% decline on the timing of certain large connected care orders shifting into the third quarter.
Right, the classic timing excuse.
Right. My first thought is always that timing is just a convenient excuse for missing a sales target. But I also understand how enterprise sales work.
How do you mean?
Well, think of it like a software company trying to land a whale client. If that client's legal team, delays signing a massive 10-year enterprise contract until July 1st instead of June 30th.
The Q2 order intake looks terrible on paper.
Exactly. The business isn't actually lost, the revenue isn't gone, it just shifts the recognition by a single day. But in quarterly financial reporting, the calendar is totally unforgiving.
That analogy perfectly illustrates the mechanism of enterprise sales cycles. And when we look at the broader data provided in the report, it actually supports management's claim about timing here.
Oh, it does?
Yeah, because even with that 1% dip in the quarter, the overall equipment order book remains at absolute record levels.
Wow. Okay.
And that order book accounts for roughly 40% of their total projected revenue. You simply do not maintain a record backlog if hospital demand is fundamentally broken. Furthermore, while North American orders might have slipped past that June 30th deadline, Europe delivered strong double-digit order growth in the second quarter.
Oh, that's huge.
Yeah. So the demand curve is lumpy, which is totally normal for heavy machinery, but it is not deteriorating.
Okay, so the top-line growth of 4% is real, and the order book delay is more of a timing issue rather than a demand cliff.
Correct.
But let's bring the focus back to those margins, because this is where the U.S. tariff refund really distorts the financial reality of the business. Walk me through the actual math of how this refund impacts the income statement.
The math here reveals a pretty significant accounting illusion. The total income from operations reported for the quarter was 609 million euros. But baked directly into that number is a U.S. tariff refund benefit of 186 million euros.
Wait, 186 million, that is roughly 30% of their total operating income coming from a single retroactive government refund.
It is a massive chunk. In terms of margin, that single refund effectively added 4.2% to the overall group-adjusted EBITDA margin. They reported 16.4% overall. So to answer your earlier question about whether the business is inherently operating more efficiently, you have to mentally subtract that 4.2% tariff boost to see the underlying operational reality.
Let's do that subtraction then and see what happens to the individual segments. Because if we look at diagnosis and treatment, with the refund, their margin looks solid.
Yep.
But if you strip away their specific 4.6% tariff boost, their adjusted EBITDA margin actually decreased year over year.
It did.
And management admits this is due to cost inflation, higher ongoing tariffs, and unfavorable mix effects. Let's pause on that last term for a second. Unfavorable mix effects usually means a company is selling a higher volume of their cheaper, lower-margin products and fewer of their premium, high-margin products.
That is the textbook definition, and it is a major headwind for them.
Right.
The core business of building and shipping massive, complex medical imaging hardware. I mean, think about it. Heavy metals, rare earth magnets, specialized semiconductors. It's all getting more expensive across the entire supply chain.
And they can't just raise prices.
Well, crucially, Philips is struggling to pass all those increased manufacturing costs onto the hospitals. The buyers are pushing back.
Which makes sense. Hospitals have their own budget crises.
Exactly. However, the story completely flips when we look at connected care and personal health. Even when you exclude their respective tariff boosts, which were 6.1% and 5.0%, their underlying margins still expanded organically.
And management attributes that organic expansion to their internal productivity measures, right?
Yeah, they are leaning heavily into internal restructuring. They delivered 132 million euros in operational savings this quarter alone.
Just in one quarter.
Just in Q2. They have these massive internal initiatives. There's Project Synchronize, which focuses on supply chain and cost competitiveness, and Simplify to Perform, which targets lean enabling functions.
Basically trimming administrative overhead.
Exactly. And they are well on track for a stated 1.5 billion euro productivity program by 2028.
See, I have to play devil's advocate on these productivity programs. I look at the diagnosis and treatment segment where underlying margins are actively shrinking. We know that supply chain cost inflation is incredibly sticky, and geopolitical tariffs aren't going away anytime soon.
No, they're not.
So can internal cost-cutting programs like Project Synchronize really outpace structural global inflation forever?
It's a tough ask.
Right.
Yeah.
Because instead of the old cliche of squeezing blood from a stone, I look at it like optimizing a factory line. You can only speed up the conveyor belt and fire so many middle managers before you start, breaking the machinery and losing quality control. Cost cutting has a hard mathematical floor.
That observation highlights the exact risk every institutional analyst is modeling for this stock right now. You simply cannot shrink your way to long-term profitability in a high-inflation environment.
We just can't.
Once you hit that mathematical floor on cost cutting, you have to find margin expansion through pricing power, like actually forcing hospitals to pay more, or through a superior product mix.
Right.
If inflation persists at current levels, Philips will be forced to rely entirely on their innovation pipeline. They have to introduce higher margin premium products to offset the rising cost of raw materials and shipping.
Which transitions us perfectly into the macro environment and the specific risks management flagged in this report. Because tariffs and supply chain inflation are really just symptoms of a much larger global shift that Philips has to navigate.
The report is unusually explicit about the macro landscape, honestly. They cite deglobalization and protectionism as major ongoing headwinds.
Which makes sense for a company like this.
Totally. For a company that designs in Europe, manufactures globally, and sells across every continent, protectionist trade policies act as a direct, unmitigated tax on their operating margins.
They also specifically called out centralized procurement expansion in Greater China. The guidance notes they expect sales there to be broadly stable, not growing. And centralized procurement essentially means that instead of Philips sales reps negotiating with individual hospital directors who might want all the premium features, the Chinese government is buying medical equipment in bulk at the provincial or state level.
Yes.
They're using their massive purchasing power to squeeze vendors on volume pricing.
It fundamentally alters the sales dynamic in one of their largest markets.
Yeah.
You're basically trading high-margin, bespoke hospital sales for lower-margin, high-volume state tenders.
Which hurts the bottom line.
It keeps the revenue stable, like they noted, but it puts an absolute ceiling on profit expansion in that region.
Well, since we are discussing risks, we have to address the absolute elephant in the room here. When Philips reiterated their 2026 financial guidance, they included a massive, glaring caveat.
Oh, the legal stuff.
Yes. They explicitly stated that their outlook excludes ongoing Philips Respironics-related proceedings, and that includes active investigations by the U.S. Department of Justice and various state attorneys general.
Yeah, this is the ongoing fallout from that massive sleep apnea machine recall, which has, plagued the company for years now.
But for a retail investor trying to value this company, how are you supposed to confidently model future cash flows when management explicitly puts a blindfold on you regarding a potentially devastating regulatory penalty?
It's incredibly difficult.
I mean, they are essentially telling the market, here is our cash flow projection, assuming the U.S. government doesn't hit us with a multi-billion-dollar fine.
It represents the literal definition of unquantifiable risk. From a valuation standpoint, institutional investors usually apply a steep discount rate to the stock price to account for this exact uncertainty.
Because you just don't know the number.
You don't.
Yeah.
Management excludes it from their official guidance because legally and practically, they just cannot predict the outcome or the timeline of a DOJ investigation. But as an investor managing your own portfolio, you have to mentally model a worst-case scenario payout. You have to look at their balance sheet, look at that $1.5 to $1.7 billion in free cash flow, and ask yourself if the company can absorb a massive financial penalty without having to slash the dividend or issue new dilutive shares.
Okay, so given that massive legal overhang with the DOJ, the margin pressures in their heavy hardware division, and the pricing pressure in China, what is the bull case here? Why would an investor look past all those systemic risks?
The bull case rests entirely on two pillars: capital allocation and high-margin technological innovation.
Okay, let's start with capital allocation.
So despite all the challenges we just outlined, they still paid a €0.85 per share dividend. And notably, 43.8% of shareholders opted to take that dividend in cash rather than reinvesting in shares.
Oh, wow. Almost half.
Yeah. The fact that the board authorized that cash outflow signals a baseline level of confidence in their current liquidity and near-term cash generation.
So they aren't hoarding every single penny out of fear of the DOJ.
Exactly. They're maintaining shareholder returns. But the far more compelling pillar for long-term growth is their innovation pipeline, particularly where their traditional hardware intersects with AI and high-margin software.
Right.
For example, they just launched Smart IQ for the Azurian platform. This is a critical development. It reduces X-ray radiation in complex coronary procedures by over 50%.
Let's look at the mechanics of that, because a 50% reduction in radiation is a massive safety upgrade for the patient on the table, obviously, but also for the physician who is standing in that room performing these procedures every single day.
And the way they achieve that reduction isn't just by putting, like, a thicker physical filter on the
Oh,
machine.
it's not.
No, they are using advanced AI software to reconstruct the imaging data, allowing the machine to emit far less raw radiation while still producing a crystal clear image for the surgeon.
Oh, wow, that's incredible.
It is. And that is a premium software feature that hospitals will gladly pay up for, which directly helps offset the manufacturing cost inflation we discussed earlier.
They also unveiled the AI-powered titanium MR. The report describes it as an ultra-high gradient 3.0T MRI used specifically for radiation therapy planning.
Right, so the 3.0T refers to the strength of the magnetic field. It provides incredibly high-resolution images compared to your standard hospital MRIs.
Okay.
But the real breakthrough is the 4DMR software solution attached to it. It allows oncologists to visualize moving tumors in real time as a patient breathes.
Wait, really? As they breathe?
Yes, and if you can track the tumor's movement perfectly, you can target the radiation therapy with much tighter margins, which spares the surrounding healthy tissue.
That is amazing.
Again, Philips isn't just selling a giant magnet here. They're selling the proprietary AI-driven software that makes the magnet exponentially more effective.
It's a fundamental shift in the value proposition, really. They are moving the profit center from the raw metal and copper of the machine to the proprietary code running inside it. Because hardware margins are capped by the price of steel and shipping logistics, right? But software margins, once the development is actually paid for, can approach 80 or 90%.
That transition from hardware margins to software margins is ultimately what could save their diagnosis and treatment segment from being completely eaten alive by supply chain inflation and centralized procurement.
Which brings us to the final and perhaps most important takeaway for you as you look at this company for your own portfolio. Because when you look past the noise of that massive U.S. tariff refund and you look past the day-to-day lumpiness of the quarter-to-quarter order intake, there is a fundamental structural shift happening at Philips.
It's a complete shift in how healthcare is delivered globally, and more importantly for investors, how Philips monetizes that delivery.
Right. Buried in the innovation highlights of this Q2 report was a massive tender. They won with Karolinska University Hospital for Region Stockholm's Hospital at Home initiative.
That is a huge deal.
It is. Philips is going to be providing remote patient monitoring and AI-enabled clinical services for up to 15,000 patients annually. They also signed 10-year enterprise imaging partnerships in the U.S. and with the Imperial College Healthcare NHS Trust in London, deploying full cloud software as a service.
This really represents the crux of the future valuation for this company.
So as you digest the numbers from this earnings report, here's the thought I want you to walk away with. Philips is actively pivoting from a traditional manufacturing company that sells expensive MRI machines one at a time to a technology company that signs decade-long, cloud-based enterprise software contracts.
It's a totally different business model.
It really is. Think about how a recurring revenue model, getting paid month after month, year after year for AI monitoring and cloud data management, might completely change this company's margin profile and stock valuation in the coming years. If they can survive the impending DOJ investigation and manage the brutal hardware inflation, this quiet pivot to software as a service could be the real growth engine hiding beneath the surface.
Absolutely.
Thank you for joining us on this deep dive as we stripped away the corporate speak on Philips's Q2 report. Make sure you follow the show so you don't miss our daily earnings coverage, where we keep breaking down the financial mechanics and the numbers that actually matter to your portfolio.